Hello, I'm Cal Ewing, and in this video, I'm going to share with you the 6 important things that I look at when I'm investing in a mortgage note. These are things that if you're just getting into the real estate and mortgage note investment business, you need to consider when you're making offers on notes and having as part of your business system to protect yourself, to make sure that you're buying the note right, and then you're getting rid of any risk of mistakes or things that can happen that can affect your investment, your profitability, and even prevent you from taking a loss on your investment. All right, so these are the 6 important things. I'm just going to share my screen right now, bring that up. Okay, so number one, at least in my business, we're only interested in buying first lien mortgage notes. Okay, so you may be aware, maybe not, but there's different, positions that a lender can have when they have a mortgage on a property. So a good example of this is sometimes people will buy a piece of property, like a house, and they're going to have a note or a mortgage on the property for most of the purchase price. But then let's say that they want to do a kitchen renovation as well when they buy the house. Okay, so some banks will actually loan them the money to do the renovations, but they're going to consider that a separate mortgage, and that's going to go in second position. So that might be, say, a $30,000 renovation loan that they're going to put in second lien position behind the primary large mortgage for the purchase of the property. Okay. Another example is maybe you want to do a cash out some of your equity. You need money for whatever reason, maybe again renovations later down the road after you've bought a house, and you can sometimes get a second lien on your property, second lien mortgage, take out some money and use it how you need to. And so now you've got 2 mortgages on your house that you're going to have to pay off. Okay. Now, when there are different mortgage liens on the property, whatever's in first position gets priority. Okay, so that means that if there was ever a foreclosure, the first lien position is going to be the one that gets paid off first, and then the second lien and third lien and whatever's behind it. Okay, so I don't really want to be buying second lien mortgages because I don't like the idea of taking the risk of having another mortgage in front of me that is going to get paid before I do. Okay, because then you got to be careful if the borrower stops making payments on their first mortgage, the first lien mortgage, and that first lien mortgage holder, that bank forecloses, I may not get paid for my second lien mortgage. That's the investment I made in that mortgage to buy it. Okay, so I don't like that risk. And there's also not a really good market right now for second lien mortgages anyways. So it makes sense to just only focus on buying first lien mortgages for investment purposes. All right, number 2. So as soon as we make an offer on a note and it gets accepted, we have a due diligence period. And in that period, we want to make sure we know all the details that are going on with that mortgage note and that property. And number 1, we need to know what the value of that asset is in its current condition. And this is, of course, we're buying the note. We're not buying the property itself, but we're buying that note, which is secured to that property. That's the collateral that's securing the investment and securing that loan. And so we need to know exactly what that property is worth in its current as is condition. And the way we do that is called a broker price opinion, or BPO. Okay, so we're going to hire a realtor in that market that knows the market well, and they're going to provide a broker price opinion and give us the as is value of that piece of property. And we want to know that before we buy the note so that we can make sure that our offer makes sense, and that everything is perfect and correct, and all of our assumptions are correct before we go and spend money on buying on that note. The worst thing that could happen is we find out that our values were wrong, or the value of the asset is incorrect that was provided by the bank. Because usually what happens is when you buy a note, they're going to provide a value estimate, and we want to make sure that we verify that and make sure that we know that value is correct, or maybe it's incorrect, and we want to have the actual number so that we can make appropriate decisions on our purchase price. Okay, number 2. So once we know the value of that asset, we are only going to buy that mortgage note or make an offer on that mortgage note at 70% of that as is value or below. Okay, and the reason we do that is we want to make sure that there's always some equity there to protect us should the market change, should we have made some slight errors in our assessments, that kind of thing. There's always a little bit of wiggle room, right? We're not ever dealing with exact numbers. And so as long as we have that 30% buffer there, we can be very confident that our investments is secure and safe, and the chances of us profiting from this investment are higher because we know that there's at least 30% difference between the purchase price of that note and what the actual property value is. And that way, if we do have to foreclose on that borrower and sell off that property, we know that there's going to be plenty of room to make sure that we get our investment back. Okay. The other thing we do when we're doing our due diligence up front is we want to get a really clear picture of the title history of that property. Okay. So we hire a third-party company that does a full title search. And basically, we hire them because it's a lot of work and they specialize in this type of thing. This is what they do. And so they know all the ins and outs of title searches. They know where to find all the information for a specific property. And so we can rest assured that we're going to get all the accurate information pertaining to that piece of property. And that's including any mortgages on the property. We want to know any liens. Maybe there could be city mowing liens or assessment liens for work done that the city did on the property that they put a lien on the property for. IRS income tax liens, state tax liens. There could be, again, like a second mortgage, something like that, other mortgages on the property. And then we also want to look and see the chain of ownership to make sure that there's no issues in the chain of ownership from one owner to the next. Because sometimes there's been errors that have occurred where a title company makes a mistake, and we don't want to buy a mortgage note and then find out later that the owner of that property isn't actually the rightful owner because there was an issue made or a mistake made in the past. And then the same goes with the mortgage that we're actually buying. So banks will assign mortgage notes from one bank to another over time. And we want to check the ownership history of that note to make sure that there's no errors that the title companies or attorneys made when they were preparing the mortgage note assignment documents. We want to make sure that the grantor and the grantee names are all the same so that we don't find later on that there was a mistake and we don't actually own any note at all. Okay. So that's very important. There's a lot to that. And so we want to make sure we have a third-party vendor doing that work for us. Okay, and then we also want to make sure that we have a very solid third-party loan servicing company handling the note once we buy it. Okay, my job is not to be doing the day-to-day bookkeeping on a mortgage loan that we own. I want to have a third-party professional who is skilled and does it all day long, handling basically it's the bookkeeping. That's what loan servicing is. They're collecting the payments from the borrower. They're sending out monthly statements to the borrower and to us as the mortgage lender. They're sending out annual statements. They're keeping track of late payments and late payment fees. They're going to let us know, if it's time to start looking into maybe foreclosing because the borrower's been late and not paying. So they're really the eyes and ears on that mortgage and keeping track of the day-to-day operations of that loan. And when you've got multiple loans in your portfolio, especially, the last thing you want to do is try and balance all these different loans. I'm not a bookkeeper. It's not what I want to do. And so we have a third-party professional handle that for us. Okay. And then the other great thing about having a third-party loan servicer handling your mortgage or the note is that you want to be able to have really good solid records. So if you ever want to sell that mortgage note later on, you can provide the entire history of the servicing that has been done on that note, and so that the new buyer can do their own due diligence on the payment history and performance of that note, so that they know whether or not they want to make a purchase of that mortgage note or not. If you don't have that information available, it's going to make it a lot more difficult to sell it to another investor someday if that's what you want to do. Okay, then about 25% of the time, maybe even up to 50% of the time, when we buy a mortgage note, we're buying mainly non-performing mortgage notes. And what that means is the borrower has not been making payments for at least 90 days, maybe longer. Okay. So the reason we do this is we're able to buy these notes from banks at a very steep discount. And sometimes we can get the borrower paying again, which is our primary goal. But other times we end up having to go through and foreclose on the borrower as the new bank, basically, as the new lender. Okay. We have the right to foreclose if they're not making their payments on the loan. Okay. Now, we buy in multiple states across the US, and I personally cannot be a foreclosure expert on all of the rules and steps and laws and regulations and procedures in every single state. And nor do I want to do that. And so I employ an attorney that's skilled and specialized in foreclosures in that state where the property is located. Okay. And when we basically hand it off to them, we make sure that they are handling it for us, and that they're obviously they're in the know. They know the proper steps and procedures to follow. And so we don't have to worry about that. We know that the mortgage is in good hands and the foreclosure is going to get done correctly. All right. And then the last thing we always make sure we do when we buy a mortgage note is we have forced placed insurance put on that note to protect us and that property, to protect us as the lender, to make sure that we're fully covered and insured just in case we buy that note and then the next day the house catches on fire, gets flooded, something like that. We want to make sure that we are always protected and we have an insurance policy covering us as the lender, not only just the homeowner and borrower, but us as the lender. We want to have insurance as well, so that way, if there was a hurricane and the house flooded, we are protected as well. And the investment that we made in buying that note, we're going to be okay because we're going to be the one that can claim the insurance money from that disaster. Okay. And I know this firsthand as a real estate investor investing in Houston, Texas in 2017 when Hurricane Harvey hit. Thank goodness, 2 of our flips that got flooded, we had insurance on the property as the property owner. And our lenders also had insurance on that property. We had hard money lenders on that property, and they were also included in our insurance policy as a lender. And so none of us really lost anything because of the fact that we had insurance and everyone was covered, and we were able to get the insurance money and redo the rehab and sell the property off. So everyone was good because we had insurance. And I would hate for us to have a mortgage note and then lose the collateral because it burns down or floods. Okay, so very important there. All right, so those are the 6 important things that we look at. If you're considering investing in notes, these are things you should also consider when you're doing your due diligence and implementing them into your business and building your team so that you can handle buying multiple notes in your portfolio. You want to have all these vendors that can do these jobs for you. So that you can spend your time doing what you do best, which is finding more note deals to buy and analyzing them and making offers on notes. With that, if you're interested in taking part in some of these note deals with us, we are always looking for funding partners, private individuals that lend out of their self-directed IRA retirement accounts, or maybe just have savings that you'd like to get earning a better return on investment for you. We work with people as funding partners and private lenders to help us purchase these mortgage notes. And there's other videos in our YouTube channel that explain a little bit more about what that looks like and how we analyze a deal. But these 6 factors are important. And these are things you should be aware of if you're considering investing in a mortgage note as a private lender as well. So if you'd like to talk more about this, there is a link below this video. You can click on it and schedule a call with me. We can go through some of these 6 important things in more detail, and I can answer your questions and explain a little bit more about what note investing is all about. So until next time, I'm Cal Ewing. Thanks for watching. Make sure you subscribe to this channel if you're watching on YouTube, and I look forward to speaking with you soon. Take care.